Welcome to the Common Fund Point of View. I'm Julia Mord, Chief Investment Officer of Common Fund OCIO. I joined the firm in April and will be taking over as the host of this podcast from my colleague, Anita Harriton. Today, I'm joined by Chris Quate, Chief Investment Strategist, who will be retiring from the firm on June 30th after 20 years. In this podcast, we look to give you our latest views in 15 minutes or less. With the transition from Anita and Chris to me, I plan to maintain that easily digestible format, but we'll mix in different guests and topics along the way. I hope you continue to listen going forward. When we last hosted a client webinar on April 9th, markets were deep in correction territory following the announcement of the tariff policy on Liberation Day. Just 2 months later, markets have rebounded sharply, up 20% from their lows, as many initial concerns about the impact of tariffs on the US and global economies have eased. This shift followed the Trump administration's decision to implement a 90-day pause on nearly all reciprocal tariffs, along with early progress on bilateral trade deals, including a notable agreement with China. Chris, I'm sure many of our clients are wondering, in light of all the dynamic policy changes and the strong market recovery, what does our dashboard currently show? What has changed since our last quarter?
From a dashboard perspective, I think the most significant change is the downgrade we had, recently with global growth, and I think we tend to think of it as a domestic issue, but actually, we believe it's a global issue because all trading partners are going to feel impact from this, and even though we don't know exactly where tariffs are going to be, we believe we will have tariffs, and they're probably going to be higher than we've had in 75 plus years. So as far as growth, it's slowing for sure, but earnings are still coming in decent. Market's expecting about 13% growth now. So that's come down a little bit, but that's still double-digit growth. And I think we believe as a firm what we've seen more in the market is movement from a valuation story, where we kind of got cheaper for a little bit and then snap back to a little more expensive. I don't really think we've seen major changes in earnings. And I think the other change that we made in a previous meeting was inflation, where we acknowledged that it's improving, right? And we have a trend downward. And we, but we also know that while we could continue to see improvements in important areas like housing, like labor, groceries are coming down, gas, thankfully. But we do, as a firm, still remain cautious about goods inflation due to the unknown impacts from tariffs. And we remain a little bit concerned about employment, as it's certainly slowing. The leading indicators we follow, like job openings, temp work, quits rate are all down. And U.S. companies are now hiring at the slowest pace in more than 2 years. But we're not having large job cuts outside of government. And what we're seeing is folks leaving the workforce, and these positions are just not getting replaced. And so at our last asset allocation meeting, which you led, we decided to maintain our overweight to equities that we've held since last June. And even though markets aren't cheap, we still see earnings growth in equities, and we still see potential risks in fixed income, particularly interest rate risk. So we're underweight fixed income. And in place of that defensive exposure, we're a little bit overweight hedge funds, where we intentionally don't take equity risk, credit risk, or interest rate risk. And instead, we're focused on security-specific risk and alpha.
Let's turn to the fiscal deficit. According to the latest report from the CBO, The US deficit is currently measured at about 1.9 trillion or 27% of the 2025 federal budget. The One Big Beautiful Bill Act is measured to add yet another 3.8 trillion to the deficit over the next 10 years. What effect do you think that increasing this fiscal deficit will have on capital markets, both in the short term and the long term?
So of course, it's a hard question that we've been asking a long time, because we've had this deficit situation for a while and we've been kicking the can down the road for a while, us and other markets. I think when you have large deficits, though, it ultimately leads to sort of two paths. Either austerity, where you cut back spending, or the other path is you try to grow your way out of it. And I really think that's the path that we and most of the world is taking now. Even Europe is starting to spend. And what will be challenging, as we've seen, is how this impacts interest rates, especially longer term. And this is particularly important, as you mentioned, the debt in the U.S. It's particularly important here because a large portion of our debt is short term, and we need to roll it out to long term. But importantly, the shape of the yield curve now is pretty normal. I mean, the long run average between the 2-year and the 10-year is about 0.83% or 83 basis points, and we're now around 50. So interest rates are under control. But we think we will see changes in more in the short term in regulation here in the US, where they'll make it easy for our own banks to hold very large amounts of our longer term treasuries. And I think that's part of how we'll get bond auctions to work better with proper liquidity. And that's given that there are less foreign buyers of our treasuries now. And I think the long-term effects from this is we'll end up having more money in the global monetary system, right? As countries, including the US, try to monetize their debt. And this ultimately leads to more inflation, and not necessarily a lot more inflation in goods and services, or the way we sort of think about and measure CPI, but it could lead to more inflation over time in asset prices, like equities, like real estate, collectibles and whatnot, because money finds its way to assets and liquidity.
Turning to US exceptionalism. Obviously, we benefited from that. Do you still believe in US exceptionalism, or are we entering a phase of US assets underperforming on a relative basis?
We don't really have any reason to believe that the US is not exceptional, right? We have the highest concentration of what I would say are the strongest and most relevant companies in the world, right? And the dollar remains the world's reserve currency with almost 90% of all global transactions. But we're seeing regions outside of the US really coming back to more growth and more spending, right? Such as Europe, and which just cut again this morning, actually. And we're also seeing spending in EM and even Japan. And as you know, we are finding that our managers are seeing a lot of stock specific opportunities for high quality growth in these regions at better prices than the US. So we're keeping our geographic positioning in line with the geographic benchmarks right now. But we're not underweight the US because we see significant potential in many of the longer term, artificial intelligence themes that we do think will impact the market. And we are long-term investors with our clients. And these are themes such as clean energy and energy storage, or humanoids and robotics, certainly cloud enterprise software. You have machine learning, and then you have, the whole semiconductor supply chain. And the leaders in these areas are largely our domestic companies. I think the other thing that's interesting is that the US population is also pretty far ahead of most of the world in terms of cryptocurrency adoption. And I think this is also a leading indicator of AI and future growth potential. And to put in perspective, about 15% of the US population holds cryptocurrency, right? And that puts us way ahead of areas like China, Europe, and Japan.
Speaking of growth, how do you think growth dynamics are going to evolve this year, especially given the unprecedented policy relating to tariffs?
Growth was very just to set the stage. Growth was very different post COVID, and where we had a liquidity driven market where the federal government was funding the consumer. Now it's more about getting growth out of productivity, I think, and we're definitely getting more productivity for each worker employed. You mentioned some of the policies, and while we do think that there will be tariffs and they'll slow growth, right, as corporates have to pass on some of these costs. On the other side of that, we think there will be fiscal policy, right, that contributes to domestic-led growth, including things like tax bills, where companies can depreciate plants and equipment a lot faster, that'll encourage CapEx, and deregulation in areas like banks, right, and energy companies. So we think we'll still see growth. And while there's a lot of concern about recession, you see that a lot in the news, you read a lot in the paper, you see it in betting sites. We continue as a firm to not really see it in the cards. We have a service-led economy. It's not really cyclical. And while parts of our economy are basically at recession levels, like housing, for example, the overall economy, it's hard for us to go into a recession unless a lot of people lose their jobs.
Do we think inflation is still a risk, or is it being priced into the markets?
I think inflation is always a risk. I think what's most important now is that inflation expectations remain anchored, right, according to forward-looking market indicators. And this is different from sentiment data, where the consumer is expecting a much higher level of inflation based on headline volatility. And I think the distinction between the two is important because inflation expectations influence a broad range of factors. So we need an anchoring of expectations or it becomes self-fulfilling. But the risk is, as you said, that really if inflation expectations are under control, then we're really not pricing it into the market. And so we have to acknowledge that as a risk. We acknowledge that within our asset allocation, which considers, all right, long-term objectives. But when we think about the current environment, we still have to wait for that lagged impact of new policies from the administration, and we still don't know exactly what that is. But longer term, if we look at inflation, we do have strong forces that we believe lead to deflation, right? And when we think about our long-term inflation forecasts, we account for things like the fact that there is an aging of our population, and right, the fact that we have higher deficits long-term is probably more deflationary. We have a levered consumer right now, and so it's going to be harder to overspend. And finally, we do think that this rise of artificial intelligence should have impact on inflation. And for example, just look at how many robots are in the workforce now, not just here, but globally. right? Look at Japan, for example. So I think long term there are a lot of things that keep inflation anchored, but it's a good question. And right now, expectations are mild. There still is risk of a change in that, right? And of inflation showing its ugly head.
I think that concludes our podcast. On behalf of Common Fund, Chris, I'd like to thank you for your many contributions over the last 20 years and wish you the best of luck in your new chapter. Thank you.
You too. Thank you. Thank you, folks.